The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Scorebox Europe. I'm Steve Sedgwick with Ben Boulos, and these are your headlines. Oil prices, well, at one point this morning they ticked back above $100 per barrel, but as you can see now, just abated from that level, trading at $97.70 for the global benchmark, as attacks on merchant vessels in the Gulf ramp up, with 2 oil tankers reportedly set ablaze overnight in Iraqi waters. Energy markets remain on high alert, even as the International Energy Agency announces a record emergency stockpile release of 400 million crude barrels. The IEA and President Trump vow to keep oil flowing.
400 million barrels of oil available to the market to offset the supply lost through the effective closure of the strait.
My administration, as you know better than anybody, is also working to keep the oil flowing. It's flowing all over.
Trade tariffs back on the table. The White House launches an investigation against several key trading partners, including the European Union, China and India, under Section 301, permitting tariffs tied to unfair trade practices. And tariff headwinds take a bite out of BMW's full-year forecast, even as the German automaker posts an earnings beat in the fourth quarter. We'll hear from the CEO, Oliver Zipse, in 30 minutes' time.
Welcome to Scorebox. Crude's volatile week is continuing, with prices now sharply higher this morning. Brent has crossed the $100 mark again, as I mentioned in the headlines. Just abated from that temporarily. Well, I say temporarily, it could have, that could be the peak, who knows? Despite the IEA announcing a historic release of oil reserves, as the move failed to alleviate concerns of a supply shock from the conflict in the Middle East. Also driving prices higher this morning, vessels in the Gulf have continued to come under attack, with 2 tankers struck off the coast of Iraq, causing fires to break out, according to the UK Maritime Trade Operations. A container ship was also struck this morning in waters off the north of the UAE, causing a small fire to break out. The IEA announced plans for its largest ever release of emergency stockpiles. And I'll draw your attention to this chart. It is an absolutely fascinating chart. And I'm going to go through it because Gulf War I, 1991, 75 million barrels released. Hurricane Katrina, 2005, 60 million barrels released. 2011, the Libyan civil war, 60 million. And Ukraine in 2022, 182 million barrels. This absolutely makes those numbers look pretty minuscule by comparison as well. 400 million barrels being released as well. The IEA announced plans for its largest ever release of emergency stockpiles, with the 32 member states making 400 million barrels available. The US is set to contribute 172 million barrels to the release. Look, I just want to make one point. Before we get to hear from the president, let's just do our basic math. And again, this is very basic, back of an envelope math. If 20 million barrels a day is not going through the Strait of Hormuz, and this war goes on for 20 days, you see where I'm going with this one as well, everybody, that is 400 million barrels. What if this war goes on for 25 days, or 30 days, or 40 days, or carries on going? You can see how tight the numbers are, given the release, which is enormous historically, but compared with the amount of traffic that normally goes through that strait, that choke point. Of course, there are other ways to get them oil to market, and of course the East-West pipeline in Saudi has been talked about a lot, but so far we understand is underwhelmed in terms of the capacity going to those Red Sea ports. Speaking at a rally yesterday, the US President Donald Trump praised the move from the IEA.
The International Energy Agency agreed to coordinate the release of a record 400 million barrels of oil from various national petroleum reserves around the world, which will substantially reduce the oil prices as we end this threat to America and this threat to the world. We don't want to leave early, do we? We got to finish the job, right?
And just to say, the latest data I have on a gallon of gasoline, and Dan, you'll know this as well, $3.58 is still the average national price of a gallon of gasoline. And I'll hasten to add, it was $2.98 before the Iran action. Let's get to Dan, who's got the latest from the Middle East. Dan, great to see you, my friend.
You too, Steve. Here's how we're thinking about this from the Middle East right now. Of course, through the course of the Asia trading day, we saw Brent crude shooting back above 100 US dollars a barrel. And that really tells us that markets are saying one thing and policymakers are saying another. The math you outlined earlier, Steve, is spot on. And that's exactly why the market has responded in this way. If Hormuz flows remain depressed all the way through the end of this month, then Goldman Sachs says prices would exceed both the 2008 and 2022 peaks. Now, we've looked it up. That would be above $147 a barrel, or about 47 bucks up from where Brent crude is right now. Now, that, of course, comes after the IEA announced the largest emergency reserve release in history yesterday, 400 million barrels out from 32 member countries. And the markets basically shrugged it off. The problem, of course, is logistical. Goldman says flows through Hormuz are down about 18 million barrels a day, or 10% of normal levels. And the supply shock that we're seeing right now in these markets, it says, is 17 times larger than the peak hit to Russian production after the Ukraine invasion. The other thing we're seeing right now in the region is the fact that the pipeline alternatives, the substitutions here out of Saudi Arabia in particular, are simply not enough to plug the gap. And the recent strikes on Gulf infrastructure as well are making a bad problem worse. So there are several scenarios here. Unless we see some kind of military off-ramp, that would be a diplomatic solution, which looks unlikely at this point, or a conflict de-escalation, which also looks unlikely at the moment. Unless we saw US naval escorts through the Strait of Hormuz, which is also not likely at this point, or Iran actually agreeing to offer safe passage for ships from certain countries through the Strait of Hormuz, again, not likely at this point, then the path of least resistance for oil right now is likely going to be higher. The bull case probably staying intact given the lack of developments on the conflict front. What we also saw was 3 vessels being hit near the Strait of Hormuz yesterday. The US military, of course, as I mentioned, still not willing to escort those civilian ships through the strait either. And the UK Maritime Trade Office has been doing, look, let's face it, a pretty good job of informing the public about exactly what's happening out there right now as well. So that's where the situation stands right now. Oil prices in the crosshairs, and a really significant day for this market. The largest release in the history of the market, not doing anything to stop the price gains. It's back over to you.
Fantastic summary, Dan. Thank you very much indeed for that.
Let's see the effect all of this is having on markets. And this was the picture on Wall Street in the previous session. You can see the Dow and the S&P 500 both closing the session in negative territory. The Nasdaq eking out just the smallest of gains, marginally above the flat line. Of course, the release of that strategic reserve quantity from the oil stocks not having the desired effects on markets. Investors, traders clearly concerned about the impact on inflation and economic growth, and what this might mean for the future path of interest rates by central banks. Let's have a look at what's going on in Asia, and this is the picture during the trading session. Now, again, all of the main indices in negative territory, the concerns about inflation and the ongoing conflict in Iran, the impact on the supply of oil really weighing on the main benchmarks. In terms of what's coming ahead in Europe, this is the open that's being called across the futures. Again, tacking that trade in Asia following the negative sentiment. And also another thing that's going to be watched closely is this trade investigation by the US and what that might mean for trade between the US and Europe going forward. Steve.
Thank you very much indeed. Let's get to Ben McWilliams, who is affiliate fellow over at Bruegel. Ben, thank you very much indeed. Look, really simple starting question. What do you make of the latest news flow and what it means for Europe?
I mean, your math at the beginning of this episode is spot on. This is 400 million barrels. It's a record in terms of release from the IEA, but it's still equivalent to 20 days through the Strait of Hormuz. We've seen that in the markets. Prices haven't really gone down since that release, and as you've already discussed, since more attacks today, they've gone up. So while releasing barrels is helpful and it can do something to calm markets slightly. And I think it is still doing something to calm markets. This is not a fundamental solution for Europe. And Europe, for as long as this crisis goes on, will remain exposed to energy markets. By the way, both oil, but also natural gas, which we haven't discussed yet.
Let's talk about natural gas. We're still getting shed loads of LNG from the Russians as well. There is a 2027 target to not do that anymore, but it's hard to see how Europe can't when it needs to find other sources. And I've had other commentators saying, look, we don't want to change our reliance on one set of oil and gas for another, i.e. rely too much on US product coming into the continent.
It's tricky. Again, natural gas, it's 20%. It's mostly Qatari LNG, which no longer can move through the strait. Most of that was going to Asian consumers, but now what we see is this reverse scenario to 2022, when Asian buyers are coming onto the market and we see US LNG cargoes in the Atlantic turning course and going to Asia. So this is pushing up prices in Europe. We see natural gas prices doubling now. I would say for natural gas, there is some demand side flexibility. You can have some power sector switching. Industry will be able to play a little bit with demand. And one benefit for Europe is that it now comes out of the heating season. It's just warming up over here in Europe, and hence the challenge now is about how do you ensure you get enough natural gas in storages over the summer ready for next winter, which is still very challenging, but far less so than trying desperately in November to get gas in to heat homes.
Ben, it's interesting, this release from the Strategic Reserve, but of course it's not going to come online immediately, is it? There will be logistics. All of these are kept by the individual countries. Some will be quicker at releasing them than others. And of course, this is crude, isn't it? It still has to be refined before it can get into the system and actually be used in industry.
Yeah, the two elements, we don't know exactly when this will come to market, and I'm sure policymakers thinking about this, and I think there was a little bit of discussion in the IEA, are probably not sure how quickly to bring this to the market, because it really, again, depends on how long this is going to go on for. If we knew, which of course we could not know, that in a few weeks this would be over, then you can bring them to market today. But if there's a worry that this is going to go on for weeks and months and even longer, then it might be a temptation to bring it slower to market. I'm not sure that plays in. I think they've made the decision and they'll bring it to market. And then there's the second element you raised, which is that this is crude oil, and we will see increasing bottlenecks on the product side. That region, particularly for jet fuel, for kerosene, is very relevant, and I think we'll likely see tightness in the market there, only growing over time, which this crude release can help. It still, of course, needs to pass through a refinery. And again, this is back to 2022 with diesel, then was the case coming from Russia. You always see these bottlenecks further along the oil supply chain.
I'm just looking at the oil price numbers there as you were talking, and this is almost a worst case scenario for the IEA, isn't it? It's not just that the market hasn't responded or has been lukewarm to the release. The prices have surged despite the biggest release in history. And I just wonder, what else can they do? What else is in the armory to try and deal with this?
It's demand side. There's no more on the supply side you can do. I mean, you'll start seeing alternatives, some other supply. I'm not sure in America, there's a little bit of spare capacity, not too much, I don't think, but you'll see some supply side reactions. You'll see in the Middle East, there'll be some attempt to get barrels to the market that don't have to go through the strait, but that's going to be no substitute at all. And eventually it's going to have to be demand side measures. I think we're already seeing Asian economies coming out with some sounds on how they're going to try and do this. And I think for policymakers, the challenge is to try and do demand side measures in as least a painful manner as possible, trying to do it in a sensible manner, avoid sort of rushes to the petrol station to fill up, and try and do this in a smooth way. But ultimately, there is no way to replace 20 million barrels of oil and natural gas, which come through the Strait of Hormuz. And it's going to have to be an adjustment on the demand side over the coming weeks and months, or getting the strait opened again.
Yeah, but I'm more optimistic over the medium term, Ben, because I think a process that started with the start of the Russia-Ukraine war has accelerated the adoption of more forward thinking across Europe about pipelines, about infrastructure, about grids, and also, dare I say it, about alternatives as well, with some really sensible conversations about the alternatives as well. One thing that these higher prices do is obviously create a better financial incentive for alternative measures, including electric and what have you. So medium term, I think this could act as a positive catalyst.
Strongly agree. I would point you to two countries to keep an eye on in the next days and weeks, which are Spain and Portugal. Spain and Portugal, I think all of Europe took the correct message from 2022, which was to double down on the energy transition, get off imported fossil fuels. but particularly Spain and Portugal really pushed ahead and installed a lot more solar and wind. And they're now at the point where for many days, they're able to meet electricity demand, particularly without the need of natural gas, or for many hours at least. And it will be an interesting one to monitor, but I suspect that in the coming days and weeks, we'll see a little bit of a decoupling in prices, where electricity prices, which of course are relevant here because natural gas so often sets the price there, will be lower in Spain and Portugal than in other parts of Europe, countries like Italy, where particularly natural gas is still playing a crucial role. But that long-term message that the only solution to this volatility that comes from importing oil and gas is reducing your demand of imported oil and gas. And we know how to do that. It's just this is a longer term play, and this comes over the next months and years. But again, for Europe, 2022, now again in 2026, yet another energy crisis. I'm sure that message is getting home to policymakers.
Yeah, absolutely. Ben, I've really enjoyed the conversation. I know our own Ben has as well. A smart and considered conversation without all the hyperbole that we hear from a lot of commentators. Thank you, sir. Ben McWilliams, affiliate fellow over at Bruegel.
Still to come on the show, Henkel sees weaker consumer sentiment and uncertainty around the war in Iran. We'll discuss more with the CEO, Carsten Knobel, next. Plus, BMW posts an earnings beat in the fourth quarter, but weakness in China hits sales. We'll hear from the CEO, Oliver Zipse, in the next few minutes. And don't miss our interview with the CEO of Informa as the company reports full-year earnings. Stephen Carter will join us right here in the studio later this hour, and that is a CNBC exclusive.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's the CEO of the London Stock Exchange Group, Julia Hoggett.
There is no justification whatsoever for not doing the right thing, even if the right thing is hard to do. Which also means that if the context changes or the information changes, it is absolutely fine to also change your mind.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Hello, welcome back. Shares in Henkel fell on Wednesday after revenue came in slightly below analyst expectations amid concerns of a softer start to 2026. The company pointed to persistently weak consumer sentiment and uncertainties from the war in Iran as concerns for the company heading into the year. Well, I'm delighted to say that Carsten Knobel, the CEO of Henkel, joins us right here in the studio. Carsten, good to see you. Very warm welcome. So let's kick off.
Good morning.
So much happening in the world right now. What is the impact on your company and your projections for this year on what we're seeing in Iran, the oil price, and the general situation?
So good morning, Ben. Good morning, Steve. So thanks for having me. And yes, you pointed out the results, what we presented yesterday. And I have to say, the business performance in 2025 was really good. You know, we have done a lot of execution well during the year. We're investing into the future. The strategy is working. And maybe some numbers on that. You know, we came in with 20.5 billion of turnover. In organic terms, up close to 1%. We increased significantly our margins in that environment, which is definitely a tough one in 2025. We have been an EBIT, means earnings before interest and taxes, of around 3 billion. We increased our earnings per share with 4.7%. And I think important, we're proposing to increase our dividends to our shareholders by 1.5% based on a really strong cash flow, 1.9 billion. And the company is net debt free, which helps us to invest into the future. I think that's the overall perspective of 2025, but in a tough environment. And you're right, 2026 and going into 2026 is not easy, not only because of the things which we have seen already in 2025, but also now the war in the Middle East is impacting for sure the business of us, but also the sentiment overall. What we currently see is that the consumer sentiment in the US and Europe is at the lowest levels we have been experiencing since years, and that's for sure not an easy situation.
And presumably all of this comes at a point when you'd look at a situation where you could have hoped that consumer sentiment and demand would pick up. Inflation was coming under control. We were in a rate-cutting cycle. People's borrowing costs, mortgages were coming down. And yet now we see inflation expectations rise once again. People are anticipating their mortgages are going to cost them more. They may be preemptively reining in their spending. What sort of response do you have to that as a business?
Now, I think the best answer and the easiest answer is innovative products. You need to bring innovations to the consumer, either in terms of that it is so different that he's willing or she's willing to pay more, that you have also the possibility to convince in terms of competition. At the other point, I think you need to have a portfolio which is also covering different parts of the consumers in terms of value for monies, but also up to premium. And we have done that over the last couple of years, adjusted our portfolio, optimized our portfolio, and I think therefore we are in general good positioned. And that's also why I'm still optimistic for 2026. We want to increase sales and earnings also in 2026.
There's a lot of genius consultants out there who will always tell you how to run your business and tell you which portfolio you need and what you don't need as well. We see it whether it's Procter & Gamble, Reckitt, Unilever. We can see it all the time as well.
Yeah.
Have you got the right portfolio at the moment? Are you under pressure? You talked about the variety of products, of course. Dare I say it, some of those genius consultancies will tell you need to be more specific and more focused.
I think a strategy and portfolio is always, the job of the management board and not of consultants, despite the fact that you can also get support on that. But I think looking back at Henkel, I would differentiate. In the industry part, which is half of our business, we are the number one in the world, and I think our portfolio is serving 800 different industry segments, and I think we are really well positioned. In the consumer space, the other 50%, we have been doing our merger of our consumer businesses under one platform the last 3 years. We are 1 year ahead in terms of that we finished that. And over the last years, we have been taking out more than 2 billion of revenue of our portfolio in that context. And I think we are now well positioned. We have 2 global categories, hair and laundry and home care. And I think that's the right portfolio for us going forward.
Looking at the auto industry, the traditional marques, the fantastic German marques, what have you, they've been decimated in some of these emerging markets, especially China, because the new brands have come up the rails as well. China and the consumer seems less desperate to buy those well-known international brands than they've ever been as well. Are you finding yourself under pressure from local competitors more than ever?
Now, first, if you talk about the automotive industry, that's for sure a big industry in Germany. And yes, the current situation is not easy. And also we are suffering from that because, as you have seen, the automotive German manufacturers are under pressure. On the other side, out of 150 cars which are produced, 140 have also products from Henkel. Means we are an
I did not know that.
Yeah, we have an international.
Absolutely fantastic.
Yeah. So we have an international setup. We are supplying every automotive manufacturer.
Is that a good thing when that sector's trading about 4 times forward PE that you're associated so closely with the autos?
Yeah, I think it's good that you have this compensating effects. And when you said China and Germany, both markets are under the top 3 within our portfolio. China, in the meantime, number 2. Germany close to number 2 and 3. So that is the setup. And for sure, yes, local competition is always dangerous, but especially in our industrial business, I think we have a very technological-driven business where we have, high hurdle rates for others to step in. So therefore, I think we are well positioned despite the challenges which are happening currently in the automotive market, which is roughly 20% of our business in the industrial adhesives business.
Carsten, I know that you've expanded the hair care business with the acquisition of the brand Not Your Mother's, which is a US brand. Just to get your thoughts on the latest twists and turns on the tariff situation, this announcement that the US is going to investigate trade practices, including with the EU, and may then raise, if it feels that there are unfair trade practices, tariffs to where they were before the Supreme Court decision. With the twists and turns in high tariffs, no tariffs, middling tariffs, how is that affecting you?
Now, first of all, I think it's very clear what is impacting 25 and 26. We have a lot of uncertainty. When it comes specific to the tariffs, I think these are manageable for Henkel. Why I'm saying that? We had in 2025 a low double-digit million euro impact, and the thing what we are doing since decades at Henkel is we're trying to produce in the region for the region, and we also source in the region for the region. That means for the US, more than 90% of what we are selling, what we are producing, is produced in the US. So therefore, The direct impact of tariffs is limited, but there's always a but. But you know, in terms of consumer sentiment, for sure these tariffs are impacting consumer spendings, and then in the consequence, indirectly for sure impacting also the way how people will distribute their income, and that's for sure impacting every consumer goods player in that context.